What reserves should you account for in addition to maintenance, vacancy, and property management? So I will start this off by saying the reason why a lot of people lump these things up as reserves is because it's typically a percentage of your rental income that this goes to. So property management typically is 10% of your income is what is being paid towards property management. I don't count that as a reserve. That is an expense, but it's variable depending on the income. So it's a percentage of the income that goes towards this expense. In my opinion, that's not a reserve. Reserve is money set aside for certain things. It's not actual expenses that you can anticipate. People lump it together because it's a percentage, right? So because it's a percentage, they think, oh, okay, just because reserves like maintenance and vacancy are also percentages of the income, it's a reserve, but it's not. It's an expense. So that's an expense you should account for. Even if you're going to self-manage your properties, you should still account for property management as an expense because at some point you're going to want to delegate that to someone else. Otherwise, you've just bought yourself a job that probably isn't worth your time and effort. If the deal only works because you're going to be the one to manage it, if you are not doing what I'm doing, which I've hired my own asset manager and property management and a team to manage our assets. So I know that they're going to manage it so we can have it at a discounted rate. It's going to be done in-house, right? That's one thing. But if you're saying, oh, no property management, I'll self-manage, and you're buying a real estate investment that way, all you're doing is you're buying yourself a job that you're probably not going to want to do. So property management is an expense that's dependent on the income. It's a percentage of the income that is an expense. And I'll show this all on the spreadsheet as well. Maintenance. So maintenance, people lump this together. So property management for a long-term rental is around 10%. 8 to 12% for property management is what goes towards that for long-term rentals. Depending on the market, it could be a little bit lower, a little bit higher. Mid-term rentals, typically between 15 to 25% property management. Maybe you can find some at the 10, 12%, but typically it's that 15%. Short-term rentals is around 25% of the income is what you're paying property managers. 20 to 30% really. Maybe you have some on the lower end at 15%. Typically 20 to 30% is what you're paying for short-term rental property management. And then for co-living, it depends. If they are doing all of the management entirely, maybe separate from the pad split platform, you can anticipate similar to that midterm rental all the way up to the short-term rental range, like 15 to 30%, depending on the market, is going towards co-living property management. If you are leveraging something like the platform pad split, which is finding you the tenants and all they're doing is like moving them in and, handling maintenance requests and all that, it depends on the company. Some will do it at like a long-term rental rate, maybe 10%. Some will do it even cheaper than that because it's less management because they're not actively the ones finding the tenants. And then some will charge you 15+%. So it really depends. For me, the reason to bring it in-house is so I didn't have to worry about all the different markets that we're going into. I didn't have to worry about the variability of property management and then the way they do things differently because I have a portfolio that is in multiple markets, right? I own currently in 10 markets, actively buying in 4 or 5 right now. So I don't want to not have like predictable property management and things like that. So that's why I brought it in-house. But those are kind of the numbers, the rules of thumb to help you out. Long-term rental, 8 to 12, mid-term rental, 15 to 25, short-term rental, maybe 15 to 30, depending on the market. And then co-living really depends. Operating with pad split and property management, or the property management is doing all of it. And that can range from 5% all the way up to 30%. Those are rules of thumb, right? You have to talk to the management companies in your local area, but that can help you with analysis. So once again, I do not count that as a reserve. That is an expense that is dependent on the income. It's a variable dependent on the income because it's a percentage of that. Next is maintenance and capital expenditures. So here it just says maintenance, and most people lump it up as 5% of the income goes towards maintenance, 5% of the income goes towards capital expenditures. Maintenance is basically like you got to send a plumber out to, there's a clogged toilet or a sink or a small leak. You got to replace some light bulbs for electrical. You got to do some minor touch up in drywall or paint or whatever, like a tenant moves out. That's really your maintenance costs. And then your capital expenditures are those, your like maintenance, you're paying that throughout the ownership period. Whereas capital expenditures, you're setting money aside as reserves truly for when these big things have to get replaced as your property depreciates or degrades over time. So if you have to replace your appliances, right, you need to set aside that money. It's going to cost $1,500 plus to replace some of your appliances. You need to save towards that because that's going to happen at some point. If you just replaced all the appliances, cool. You're not, that window to replace that is not like happening right away. But you don't want to be surprised and think you're making all this money when in reality, you just haven't set aside the reserves for these bigger expenses because your roof is going to have to be replaced at some point. Maybe it's a brand new roof and you have 20, 25, 30 years of life, or maybe it's 5 years out from being replaced. You're going to have to paint the whole house at some point. You're going to have to replace the flooring. You're going to have to do these bigger capital expenses that are going to need to be done for your property. Typically what people do is they set aside 5% for maintenance of the income, 5% of the maintenance for income, 5% of the income for capital expenditures. That's really what the way that it's done. That's how it's primarily done. And then vacancy is basically you can anticipate that your property is never going to be at 100% occupancy forever. If it was at 100% occupancy forever or zero vacancy, that means literally the day someone moves out, the next day someone moves in and your property is rented out. That is unrealistic even for long-term rentals, mid-term rentals, definitely for short-term rentals. Co-living, that's not feasible either. Like, your property is going to be vacant to some extent. The rule of thumb is 8% of the income should be set aside as vacancy reserves. And that translates to approximately 1 month of the year your property is going to be vacant. Like, is that always how it works out? Not necessarily, right? It just depends. That's the rule of thumb a lot of people work with, is that 8%, maybe 10%, but 8% is 1 month of the year it's vacant. That's what it translates to. And that's why a lot of people like that. Depending on your strategy, it's going to be very different. If you're doing short-term rentals, your vacancy is going to be much higher than that typically. A really great one is, 80% occupied, 20% vacancy, typically, because it's also generating more income when it is occupied. For a midterm rental, it's kind of hard to say. That's the hardest part with midterm rentals. There's just variability. For co-living, it's going to depend on your market. I'll show you how you find that. If you weren't part of last week's training, how to find, analyze, and fund co-living rentals, go look at that. I literally show you the cheat code on how you can determine what the vacancy needs to be for that specific market using data in that market. So we got long-term, short-term, midterm, co-living. It's going to, so you set aside those reserves. There's not really many more reserves you have to set aside for. I know the question originally asked something about, I noticed on your calculator setting this aside and you're setting aside reserves. I think there's a misunderstanding to how the calculator is putting the data together. So I will show what that looks like. So on this investment, let me zoom in. And just to confirm what the question is, right? What reserves should you account for in addition to maintenance, vacancy, and property management? And I'll show you how this works. And I think they got confused because they see this 441, but let me explain that. So this is what I mean by these are variable based on the income. So this is saying the income for this property is right here. The rental income is $2,450 is the current rental income on this property. So 10% of that is your property management fee. That's $245 a month. If this changes to $3,000, then so does your property management because it's a percentage of your current rental income, and so do your vacancy and maintenance and capex. They are variable based on the income, or they're also variable if this is not 10%, but it's 15%. Well, this number also adjusts based on the income times this percentage is what it's based on. It's not like your utilities or your debt, right, where it's fixed. It's variable depending on your income a lot of the time and the percentages that you're being paid. All right, so with that being said, this total expenses on a property account for all the debt, seller finance, property taxes, insurance, if there's mortgage insurance or some other type of loan you're paying, like maybe you're taking over someone's HELOC and you're paying that, HOA fees, utilities like water, sewer, gas, electric, garbage, landscaping, and whatever else. You got a pool cleaner, you got whatever that you're responsible for. That's your expenses plus your property management. So it's 1376 right here is P10 to P21. P10 is your sub 2 loan all the way down to P21 right here. So not your property management. Your property management is distinct, and that is presented here. You have your income, your expenses, your property management, and then same goes with your reserves right here. Your vacancy, maintenance, and capex are your reserves. This number just highlights what that is. We could even probably remove it from here if that would be easier for people. And that is the same number as here. Okay, hopefully that makes some sense. So your expenses are more so your fixed expenses. Your property management, which is an expense, but it's a variable expense depending on a percentage, and the rental income is its own line item. It's an expense, not a reserve. It's an expense. And then your reserves for maintenance and capex and vacancy is a reserve. It's not money you're paying every month, but it is money that you are going to need to set aside for if and when you have vacancies, you accounted for it and you have the money set aside for those. Or if you have maintenance and capital expenditures, then you have the money set aside for those. So then your cash flow is your income minus your fixed expenses, minus your property management, which is a variable expense, minus your reserves for capital expenditures and maintenance and vacancy. If that does not make sense to you, please let me know in the comment and I will expand on that further. That's what this number is. On a side note, I also like to account for what the reserves are or what the cash flow is without the reserves for maintenance, vacancy, and capital expenditures. Why? Well, because you know you're going to be paying these expenses and management. The reserves, you're taking an educated guess. Your property is going to be vacant for 1 month of the year, and you're going to need to set aside $441 a month, or equals 12 times, or $5,300 for vacancy, maintenance, and capital expenditures over that year. Or if you do not actually need this amount, your cash flow, at least in reality, your cash flow is going to end up being somewhere between your fully utilizing your reserves here to not utilizing your reserves at all here. It's going to be somewhere in between those two. It should never, in theory, be higher than this number, your cash flow without reserve. That's like the highest end. If you had no vacancy, like it was occupied the whole time, you had no maintenance issues, and you do not need to use any capital expenditures, set aside anything for that. But it shouldn't be higher than this because you still have property management and you still have your fixed expenses. And this is more of your worst case scenario. You have your 8% for vacancy, you have your 10% for maintenance and capex, all that's fully exhausted. That's what this cash flow is. Your cash flow is going to be somewhere in between here. And I like to see my worst case scenario be no less than 10% for that to be a deal for me. And I like to see this be much higher. I want my upside to be much higher if we are able to operate more effectively, but I also am not going to make decisions based on the fact that I can potentially, in a perfect case scenario, make a high return. It's really, this needs to hit my minimum. And then I like to see this to know, okay, well, if we operate it better and have less vacancy and our maintenance issues are, we don't have as much maintenance as come up as we anticipated, cool. That means we have more income being generated. We have more income than originally anticipated. All right. So then the question, what reserves should you set aside in addition to? There is no reserves you set aside in addition to. I think the confusion might be that someone sees this, and this is obviously the same number, 441. Oh, you can't see that there, but $441 here. It's just basically summarizing that here. I think one thing I could do is just erase that if that makes it easier, but I personally like to see the reserves, and I already have it broken down here anyway. So that could just be its own line item and just change it like basically in theory. And this now would be, so this is your total operating expenses, all your fixed expenses, your variable expenses, and your reserves. We can make that purple color so then it looks in alignment with, this is not the actual calculator, right? This is my demo version. I can make these updates later. Cool thing when you build these calculators, you can adjust them. And then if that makes it more clear for that one question that was asked. All right, so what do I account for? Those are the ones that I account for.